Learn the art of investing on Moneywise.
Welcome to this very special two-part series of the Moneywise podcast. I'm Sheetal, and this is a podcast where we simplify the science of investment and help our listeners get started on the journey of creating wealth using their income. So who better to take us on this journey than one of India's best minds in this domain, the CEO of IDFC Asset Management Limited, Mr. Vishal Kapoor. Thank you so much, Vishal, for joining us on this podcast. Welcome to the show, and how are you today?
Thank you, Sheetal, and it's a pleasure to be on the show.
So let's start with the basics, Vishal. Why should a person invest in anything? And the context to this is that all of us know of fixed deposits. They are stable, they are backed by the government, and hence returns are guaranteed. So the thinking is that I don't really need to leave my savings lying in my account. I can just put it in an FD or even an RD. And while the interest rates may not be spectacular, I don't lose anything. So why bother with any other form of investment?
And that's a great place to start, Sheetal. And I think we've all heard of the familiar concept of saving for a rainy day, right? Mm-hmm. One way to look at it is that, you want to save for a worse period when your earnings are impacted or you don't have enough, and etc. So it's basically rough times.
Right.
Now, when we do that, we still need to plan for money that can buy our essentials like food and shelter. The cost of those essentials that we were saving for, they themselves may go up, which means that when you actually need the savings to buy these essentials, it may actually not be enough. Mm. Now, that's because there's a very simple concept in finance called inflation, which is that prices of goods and commodities keep rising, even if it is gradual, and they creep up over time. And while FDs and FD-like products can definitely provide stability, and they're a good go-to product if you just want to keep your money safe and stable, they may not necessarily provide you net returns that can actually beat this inflation. At the end, your objective is really not getting met.
Right.
And when you look at certain other growth assets, like equities, for example, mm-hmm. you find that these are investment products that can actually help you beat this inflation, maybe even give you a chance to really becoming rich over time.
Right.
When you're really trying to move from saving towards becoming an investor, you really want better chance at meeting your financial outcome, whatever it is that you were saving for. And that may sometimes mean that you do have to take a bit more risk. Investment is all about having a bunch of these products, whether they're growth oriented or stability oriented, and you allow that to power, to achieve your goals while also providing some cushioning against market fluctuations.
So, Vishal, what are the best ways of investing money? For example, I have some money saved and I can add a little bit to it every month, and I hope to receive a decent amount at maturity a few years or a few decades from now. Maybe even, become rich. So what is my best bet?
The first thing to do is really identify what it is that you're trying to do, which is what is your financial goal? That's really has to be the starting point. Is it for retirement? Is it for children's education? Is it for the wedding? Or are there really even near-term goals like, purchasing an asset, maybe a car? What's your financial goal? And that's very important as a starting point. Okay. Because once you have that goal, the next step would be to try and estimate what is the time you have to be able to fructify that goal and what are the costs that you have for that goal. Now, keep in mind, the common issue here is that when we estimate this cost, you have to adjust for this inflation that I spoke about. Now, if this does begin to sound complex, don't worry. There are a lot of resources online, including financial calculators, that can help you do this very, very easily, including our own website, idfcmf.com. You can go there, you can go to a section called retirement, tools and planners. And most of these websites will give you a very simple way to estimate some of these common goals and how much they may cost based on your own assumptions. Right? A good way to start is to start earmarking some parts of your saving towards each of these goals. So let's say you've got listed 2 or 3 different goals. Just start earmarking pots of your saving for each of these. Because the need for growth and stability for each of these goals may be slightly different. If you have a goal like retirement, your need is growth of assets because you want your money to grow as rapidly over time as possible, and you can afford for it to be a bit more volatile. Therefore, you don't need as much stability, and therefore a larger allocation could be into assets like equities. Similarly, if your goal number 2 is a vacation, let's say 2-3 years later, you need more certainty, and therefore a larger part of your savings should go into fixed income products because they are more stable. You don't want too much volatility. The good thing is mutual funds like ours do offer a full range of products that can help you balance out these specific needs for growth and stability and liquidity.
Okay.
So one easy way to build your investment plan is to actually try and do it on a monthly basis instead of trying to do it at the end of the year or because of tax planning season or anything like that, right? These are several benefits. One, of course, is the discipline as well as the ease of investing. So as the income comes in, you've already allocated towards these goals, and there's a short way of actually meeting these goals. But you also benefit from something called rupee cost averaging, which very simply put is buying more when prices are low and vice versa.
Right.
And a mutual fund SIP, a systematic investment plan, does this very conveniently for you. Now, keep in mind that an SIP is not only in equities. That's a common fallacy that, it's an equity SIP. It doesn't have to be. Because if your goal is to have a specific proportion between equity and fixed income, let's say 60% equity and 40% fixed income as a case, you can easily allocate 60% of your SIP towards equity products and 40% towards fixed income products. So the point is that your targeted allocation can be very easily met through mutual fund SIPs in the proportion between equity and fixed income that you'd like.
Here's where we take a small little break and we'll be back with more questions for Vishal Kapoor. Stay tuned.
You're listening to Moneywise, successful investment ideas that create wealth. Did you know?
A 2021 survey showed that over 40% of Indian SIP investors started their first SIP in their 40s and 35% in their 30s. 24% of SIP investors are in their 20s. 33% of Indian women are more willing to start a new SIP in their 20s compared to 22% of men.
Personal finance simplified, only on Moneywise.
The conversation on Moneywise continues with Vishal Kapoor. Now to move into another domain altogether, Vishal, the psychology of investments and investors, to be specific, because let's face it, a lot of people, at least in this geography, do not like to take risks with their money. So what are the main risks that a risk-averse investor needs to avoid?
Think about it from what's the risk to you? The first risk I would say, and the biggest risk is that your financial goal was not met. That's your risk. You were trying to save for something and then eventually you were not able to hit that goal.
Right.
You must have, as I spoke about earlier, an investment plan which is specific, and then you nurture the seeds of your plan by feeding it with regular investments across the combination of equity, debt, and other asset classes that you've chosen. And therefore, discipline, tirelessly and diligently pursue this process is what helps you mitigate this risk. So you can go on doing this till the goals are achieved. So that's the one risk and the mitigant to that risk.
Right.
The second risk I'll talk about is the importance of awareness as well as the expectations we have. Investor Warren Buffett said once that risk comes from not knowing what you're doing. So be aware of your investment plan, be aware of the products and strategies that you're employing to fulfill the plan. You don't have to be an expert, but just have a reasonable working knowledge of what it is that you're trying to do. And more importantly, have a clear idea of what to rationally expect from your investments. Often we just expect too much, and that's where we end up taking more risk than what is optimal for us. The third risk I think that we should be very wary of is the risk of going overboard about any specific aspect of investing. And this could range from the extreme emotional responses of being either too greedy or too fearful, and therefore putting an excessive amount of investment into one asset class. Getting swayed and losing your balance while investing is a risk that we must try and avoid. And the last risk, and a very important risk that I want to talk about, is not understanding the importance of time that you may lose in deciding this, the starting point for your investment. The benefit of long-term compounding works powerfully for you. So don't procrastinate your investment plans. Don't delay.
Now, over the last few minutes, Vishal, you have dwelt on some of the typical mistakes that people make, but I want to dwell a little bit more on that. So in your decades of experience, what have you noticed are some of the most common mistakes people tend to make when they're working on investments or creating wealth?
The first I would talk about is the over-allocation principle to any single asset. This is really getting swayed by the market and, wanting too much when the going is good and not looking at risk and undermining really the power and value of asset allocation. So that's something I do want to caution against. The markets can get you this heady feeling, especially in a bull run. And you believe everything, nothing can go wrong. Everything's unidirectional. It's all going up. And that's when we make the biggest mistakes, and vice versa. When markets are crashing, you become so fearful that you don't look at the opportunities. That's the risk that I think even the most seasoned investors make all the time. The second one that I think, again, all of us make all the time is waiting, procrastinating, and almost analyzing too much in getting started. So we are wasting too much time in getting started with an investment plan. Once we have a plan, I think not following the plan is another big mistake that we see all the time. So, you start off with something or you don't structure it very well. You just put some random thoughts together and processes and don't really think about how you're going about doing it. This can also include, investing based on tips or whims or market hype, etc., or just following a fad. Stick to a process, stick to a plan, not just get swayed too much by the market hype. Patience is very, very important in investing. Keep that in mind, and some amount of discipline as well. So expecting too much or, changing course too early, I think is another challenge that we see very often. Reviewing your portfolio is important. You should do it at a reasonable level. Doing it too soon may lead to some of the errors or the issues that we spoke about earlier. And not doing it would mean that you've really not kept sense of whether you're on the right track or not. So doing periodic reviews of your portfolio and making adjustments based on the change in life stage or how assets have moved, etc., is also important.
Right.
Some amount of self-education and understanding some of the basics is very important. So if you're listening to the podcast, I think you're in the right direction. At least you need to know some of these basics. You should actually think about getting expert help through a distributor or an advisor for your investments, because sometimes money can be very boring. It can be difficult. And even if it is not, just having a secondary sounding board or an expert you can go and talk to try and manage your emotions can be very useful. Volatility in the market, keep in mind, is as natural as maybe breathing is for our body, right? So don't expect market to not have volatility. If it's an investment, there will be some amount of volatility because it is mimicking the broader market.
So that was part one of our two-part special with Vishal Kapoor, the CEO of IDFC Asset Management. And he's just explained to us the benefits of investment, the advantages of starting early, the risks that investors face, and the most common mistakes we can make as investors. Tune in to our next podcast, which is part two of this fascinating conversation. And that's where Vishal is going to be sharing some of his wisdom and experience regarding investments, the importance of patience and not panicking, about investing in prestigious foreign stocks. I know you've all wondered if that's even an option. You'll find out on that next podcast, and many other questions that I still have for Vishal. But for now, thank you for listening. Stay safe.
You're listening to Moneywise, brought to you by IDFC MF. Check out the rest of our series for more investment advice. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.